By 2026, Amazon, Google, Meta, and Microsoft plan to spend a combined $630 billion on infrastructure. This capital expenditure, or CapEx, represents a share of GDP rivaling the most massive industrial projects of the 20th century. This chart illustrates the financial strain of that buildup, specifically for Amazon. In just 12 months, their free cash flow dropped from $38 billion to barely $1 billion, as infrastructure costs consumed nearly every dollar of incoming cash. This cash burn has triggered an industry-wide arms race. The market sees four tech giants locked in a cycle where stopping the spend means ceding the lead, while continuing the spend drains their liquid reserves. These giants are following a specific mathematical roadmap to reclaim that $630 billion investment. You can track the market's reaction to the spending spree by downloading the Buffett Indicator iOS app from the Apple App Store. Note that all analysis here is based on public sources for research and entertainment purposes only, and does not constitute financial advice. Moving past the anxiety of the cash outflow, we have to examine the actual mechanism big tech is using to generate a return on this capital. Extreme supply constraints drive these massive costs. GPU rental prices climb as compute availability faces severe delays, creating a physical bottleneck for the digital economy. This scarcity is changing the industry's power structure. Frontier model creators like OpenAI and Anthropic are becoming the primary gateway for customers, often bypassing the traditional cloud service interface. This shift grants model creators immense bargaining power over cloud providers. Because the model is the product the customer wants, the companies hosting those models, like AWS and Google, risk losing their leverage. The tech giants are fighting to avoid being reduced to dumb pipes, searching for new ways to capture the highest margins in the AI value chain. Custom silicon is the primary defense against this loss of control. Google's TPUs and Amazon's Trainium chips are designed to bypass the expensive NVIDIA supply chain and reclaim technical sovereignty. In-house chips bypass the third-party hardware tax, returning cloud providers to traditional operating margins. These proprietary chips allow AWS and Google to offer competitive pricing, creating an ecosystem lock-in for mega clients like Anthropic. Custom silicon secures the tech giants' control over the value chain, ensuring they remain the dominant profit takers in the AI ecosystem. Beyond the hardware, Google uses AI to unlock revenue from complex, long-tail search queries. By understanding conversational intent, they convert multi-step chats into high-value advertising real estate. Meta integrates its Llama 3 model to optimize targeting and introduce overlay ads directly into videos. This increases both the ad volume and the price advertisers pay for precision. Internally, Meta is deploying AI coding agents to shrink their operational costs. These tools accelerate product development while reducing headcount required for routine maintenance. Microsoft and Amazon pivot away from monthly seat licenses. Platforms like Copilot Studio and Bedrock now monetize token consumption, getting paid for every AI interaction. Big tech generates its primary returns by supercharging existing trillion-dollar monopoly engines with invisible AI steroids. This chart shows the current disparity Wall Street is obsessing over. We see a $630 billion CapEx commitment set against roughly $150 billion in annualized AI revenue. However, frontier model revenue is currently compounding at roughly 50%. The revenue base is accelerating at an exponential rate that standard quarterly reports struggle to capture. CapEx is a leading indicator, paid upfront for hardware that will produce value for years. As that hardware goes online and the compounding revenue curve surges, the mathematical gap between spending and profit is projected to close by 2026. The $630 billion represents the calculated entry fee for the next era of tech dominance. This shift goes beyond corporate profit margins. AI is now targeting human operational expenditure, or OPEX, across the global economy. The efficiencies gained through AI coding and automated enterprise software are stripping away corporate labor costs, reallocating capital from payroll into infrastructure. Long-term, this transition requires the creation of new consumer markets to absorb the time and capital freed up by the automation of traditional work. To explore the research behind deep value intelligence, visit the deepvalues.ai community. If this breakdown helped you decode the AI economy, please like the video. The current race for compute power is a blueprint for an economy where efficiency is no longer defined by headcount, but by the density of the proprietary silicon running the world's tasks.